All right, welcome to a midday RTD live talk. Excited to have a returning guest to Rethinking the Dollar channel. And so before I get into that page, I want to give it a second, give more people time to join us, and then we will get right into this afternoon's chat. And I'm excited to have our guest because he's a international individual. He's a best-selling author, has a heavy resume, and so he's definitely a credible source of information. So let me acknowledge a couple people's presence, then I'm going to go over to the main screen. And so let me pop up. I got too many screens going again. And so let me see what we got here. All right, so we're going to get right to it. So no more time. So I'm excited to have Mr. Daniel Lacalle joining us here on Rethinking the Dollar. Daniel, how you doing, my friend?
I'm doing very well. Thank you very much for having me.
Well, I appreciate you taking time to join us here on Rethinking the Dollar for a live stream. And so this is streaming live. So my goal is to give the audience a chance to ask questions directly other than just having me ask questions. And I can't remember everything. So that's why I love being able to get the audience involved in this. So definitely we're going to touch on that. But if you don't mind, for a quick split second, for those that may not know your background, who you are, can you give us a small little window of spigot of who you are and how you've arrived at this point in your career?
Great. My name is Daniel Lacalle, and I'm a fund manager and chief economist at Tressis. I worked at Citadel, PIMCO in the past, and I'm a PhD economist. I've written 3 books in English: Life in the Financial Markets and The Energy World is Flat. Those 2 are available at Wiley, and Escape from the Central Bank Trap, which is available at BEP. All of them in Amazon in my page, in my author page. And you can find me on Twitter and on my website, dlacalle.com, DLACALLE.com.
All right, so sounds good. So thank you for giving us that rundown. So that being the case, as always, for those that are watching, if you have any questions, any thoughts throughout the chat, just let us know. Highlight at Rethinking a Dollar or the phone lines 313-462-0027. Give us a call, and we'll definitely get to your call. So I want to start off. First question, Daniel. We're approaching a new decade, and so over here in the United States, because you're over in the European area, so we have 2 different similar problems, at different levels. And so I'm going to get your thoughts on both of them. Let's start here in the U.S. Repo market. And so there's billions upon billions being brought into existence out of nowhere, and it's eventually going to actually leak out. It has to leak out somehow, some way. What are your thoughts on this repo action? Is it QE? Is it not QE? Is it beyond QE? What is it?
Yeah. Well, it's obviously QE, no? QE as definition is the central bank acting as a provider of liquidity and lender of last resort, and taking assets out of the market in order to provide liquidity. That is basically what it is doing. And it is also QE because what everybody told us was going to be temporary, a couple of days, just because of a mismatch between payments and taxes or something like that, has become permanent, like most monetary policies. So what it shows is basically what I've mentioned a few times in my Twitter account, is that the repo crisis is showing that the level of liquidity in the market is much lower than what market participants and central banks believe, and that the level of leverage is much higher. Those 2 factors are a dangerous combination. So right now, because everybody is treating it as an anomaly that will be sorted out quickly, it is acting as a stimulus on financial markets. And we have seen how November and December markets continue to call all-time highs. But we need to monitor this quite in detail, because if it becomes systemic, the reality that it's showing is that those that have liquidity do not want to give liquidity in exchange for sovereign bonds or short-term sovereign bonds, because they are already either scared about the valuations and the poor returns or the poor interest provided by those instruments, or because they have too many of them. And so we need to be aware of that.
Right. So a good thought was put in the chat, and it says, is the repo linked to the shortfalls in the pension plans? And so over here, I talk on pensions issues severely all the time here. What's the interconnectedness, if at all, and what are your thoughts on that? Some of the liquidity being used to meet some of the shortfalls, as mentioned over here in this question.
It's a great question, and quite likely, unfortunately, we don't have the information. We don't know what is driving this, because the lack of transparency is atrocious, is enormous, and we don't know which market participants are actually finding that gap in liquidity, and which market participants are unable or unwilling to provide the liquidity. But if we look at what the person that has made the question is referring to, which is the mismatch between assets and liabilities, and the mismatch between the returns that pension funds need to provide to their participants relative to the returns that the portfolio that they own is actually achieving, that is possibly one of the reasons. Unfortunately, neither him or her or us can know the answer. These things we will know probably. We will start to see that in the latter part of 2020, when individually looking at some of those pension funds, we start to see some strange figures of either expenses or a mismatch, as I said before, between assets and liabilities.
Now, last week, I think it was last week or the week before, the FOMC didn't make a move, and so they kept rates what they are. I think one and three quarters of a point, I think. And so, what are your thoughts heading into 2020? Will they be dropping it? Will we actually see the reserve currency at some point in the next couple of years, months, or whatever, reach negative or zero or negative? And then what will that look like, and how will that impact the confidence or lack thereof in the Federal Reserve system and the Federal Reserve note?
Yeah, I think that the Federal Reserve was right at not lowering rates the last time. It would not make any sense, considering that the unemployment figures and the inflation figures, core inflation figures, were better than expected. So it would have given a very bad signal of, if we lower rates with these allegedly awesome figures, then we know something that the rest of the market doesn't know. No. Now, what we need to think about is two things. How are financial asset prices going to behave in 2020, the beginning of 2020, because that will dictate whether the Fed lowers rates even in an environment in which it's not needed. If we see a correction like we saw at the end of 2018, that is extremely likely to happen. Second thing, I think that what we have to see is that if the economy continues to grow at around 1.5% to 2%, and unemployment remains at around 3% or lower, and core inflation remains above 2%, then we might get some market boosting, a couple of market boosting cuts, but no more. The logic would dictate that there would be no cuts, and some people are actually implying that. I find it hard to believe, because I'm not a believer in the reflation trade that is coming back in many of the outlooks of investment banks and financial firms.
Now, based upon the information you shared, so do you foresee the current asset bubbles continue to be inflated? Because all those funds have to go somewhere. So stocks, the housing price, all the issues we're having here, will that continue to be the case? And can we see Dow 40,000, Dow 50, or what?
Well, will the central banks try to do everything for it to happen? Yes. Now, what we need to start to ask ourselves, particularly in a year in which multiple expansion has been the driver of markets, it's not been earnings, it's not been macro. No. So what we need to start to worry is about the diminishing returns of monetary policy. Is that, yes, central banks will continue to do whatever it takes in order to pump asset prices, but will asset prices continue to rise just because of monetary policy? Right now, the reason why markets are rising every day is because what we're reading from the outlook of investment investment banks, what we're reading from so many market participants is that inflation might pick up next year, growth might pick up, that we have seen, I read it this morning, we have seen the worst. It's unbelievable because there was nothing bad in 2019. We have seen the worst already. As if, the other day, an investment banker was telling me, I hope that next year there will be some less volatility. And I said, what volatility did we see in 2019? It's been up and up and up and up, except for the month in which the Chinese devalued the yuan. So they will continue to try to inflate asset bubbles. What is very, very challenging, in my opinion, is that if macro and earnings trends don't start to change into to an improvement and a significant improvement, that we will continue to see multiple expansion. So the point is, it is very, very likely that central banks will look almost only at sovereign bond yields. And as long as sovereign bond yields remain low, they'll be happy because obviously governments will continue to borrow cheaply. But the rest, equities and other asset classes, they don't care so much about it. In fact, the ECB, in the middle of the massive expansion, used to say to investors that complained about bubble creation that, hey, look, equity markets are doing virtually nothing. No, so my point is, their number one pillar of objective will be bond yields, inflation, and unemployment. Those three, as long as they maintain the same way, they will continue to sort of keep it. So they might not inflate the bubble much further, but they might keep it where from bursting quickly.
Okay. And so I'm looking over here, I got a couple of questions in the chat I want to touch on. And so it says, one from Harry says, good afternoon, Daniel. What do you think about the trajectory of the negative interest rates in Europe? Will the rest of the EU follow Sweden and return to 0%?
I think that, unfortunately, the narrative in Europe and the narrative coming from the economists that surround the European Central Bank is that the reason why negative rates are not working is because economic agents, market participants, households believe that at some point rates are going to rise. And as such, for interest rates to work better, they need to continue to have negative interest rates, and they need to continue to be more aggressive in that sense, therefore even lowering them further. Obviously, this is a completely incorrect diagnosis. We already have the evidence from the Nordic countries that implemented negative rates, from Japan, that economic agents do not take more risk or more credit because interest rates go negative. They actually become a lot more prudent because something doesn't click, because the reality of the economy that they see relative to the price of money is not logical, and because cost of capital for companies, WACC, weighted average cost of capital, doesn't go down. Cost of debt does go down, but cost of equity rises, and therefore the attractiveness of investments out there is not improving. So, in a nutshell, unfortunately, it is very, very difficult once you enter negative interest rate territory to unwind it. And the reason why it's so difficult is because the governments that have been accustomed to those very low rates would not even be able to comply with their budgetary requirements with an increase in cost of debt of 0.3, 0.4. So think about this. In the Eurozone, countries have saved themselves 1 trillion euros in interest expenses from the policy of low interest rates. We need to, when you look at where bond yields are in sovereign bonds in the Eurozone, think about where, as an investor, you would start to think to buy those bonds if the ECB was not acquiring them. At which level? Which kind of price would you need? Maybe double, 3 times the current yield in order to at least start to think of buying a Portuguese or a Greek bond. So what ends up happening is that the ECB cannot increase rates and cannot because governments are too tied up and too addicted to the easy money policy, and it would crumble very quickly. Unfortunately, I believe that we will see in negative interest rates for longer.
Now, my next question will be, how low can negative go? Like, how low can you go before, we know the experiment doesn't work because of them not being able to find the growth they're looking for. So how low do you think it can go before the world realizes this is a failed experiment?
Well, I think that the world knows that it's a failed experiment. Now, what concerns me is the number of PhD economists and people close to governments that are saying that why not minus 5%? Yeah, because if they start from the wrong diagnosis, which is that there is a savings glut and that economic agents are not taking more risk because they believe that interest rates will go up higher, then people like Paul Krugman, and you can check it out in his blog, say you have to keep they think that you have to continue to keep lowering rates until, and I quote, investors give up. Now, this is insanity. As you know, we all know that this is insanity, but unfortunately, it's a very attractive message to send to governments, to the point that look, President Trump, when he wasn't president, was extremely against lowering rates and massive liquidity, and every day we get a tweet saying that he wants negative rates when he is in power. It's not because there is incoherence there, it's because there's a change of job.
Yeah. Interesting. Now, and so as I'm actually I'm going to pull up on the screen so people can see it, but it's a tweet, and I'm going to pull it up and I'll read it to you. And so it's a tweet from President Trump, and it's an older one, but it talks about the economy is one of the best in our history, with unemployment at 50-year lows and the stock market ready to again break another record. And all you heard yesterday, this was based upon some prior things about the market crash if you impeach Trump. And so this is him a while back. This is an older tweet here, but he was referencing and taking ownership in the very same thing he called the bubble when he ran for president. And so what are your thoughts on this impeachment inquiry? Will it happen? If it doesn't happen, even Trump himself says, if you impeach me, the markets is going to crash. So is he foretelling or predicting something, or what?
Well, let's start from the impeachment process right now. The way that I think that the market is discounting it is that the impeachment will not succeed at all. And I think that is pretty evident in the way in which markets are behaving. So that in itself might be a risk. I don't know. Obviously, it is true that if you look at the composition of the Senate and the composition of the House, then you can imply that it's not going to succeed, as other impeachments did not succeed in the past. But there's a ring of truth there in the point that if markets are discounting that there's not going to be any success in the impeachment, and markets are discounting that that President Trump will be reelected, any change to that can cause a big move in volatility in markets. My thought is that you need to at least have a certain level of probability of any of these events happening. Obviously, I don't think that the Democrats are going to stop the impeachment because the market goes up or down. Actually, it's a completely different process. But I think that what is a reality is that there might be some truth in the belief that everything is too optimistic about the U.S. economy, and that the slightest change can make a big difference in the equity markets, if that makes any sense. I think that is the way that I would interpret that tweet, in a less partisan or personal view. Yeah. But there is a certain level of truth that the view about the U.S. economy is that it's unstoppable. That is true. And there are positives. It is true that the economy is doing better than what many expected, because too many probably expected a recession that was very unlikely. But you cannot say that it's not in a slowdown, and you cannot say that there are no risks. Obviously, the deficits and the deficit and the level of debt in households, and weakness in some areas of consumption in manufacturing, etc. All those things have to be taken into account. So I would welcome a little bit less optimism and a little bit less consensus about things in such a black and white way.
Interesting. And so we have a question here. Let me see here. It's about, I think it's a little bit older, but it's about the repo activity and precious metals. So let me find that. Let me see. I had it, but I moved on. So let's talk about precious metals. And so the question was about the repo activity and the excess in liquidity. Will it eventually spill over into the commodities sector when it comes to silver, gold, copper, and things of that nature? Will we see some type of response from the public to where they decide to, hey, they're going to just create, let's go buy?
Yeah, well, I think that more than the repo crisis, which I think that everybody has seen, that the Fed has given a very clear message that they will inject whatever is needed, the same way as the Chinese central bank, the PBOC, did the same thing. I think that more than that is the perception that something, that all this exuberance and all this optimism about the market in itself is starting to show some cracks, and that it's good to have something that's tangible, that is proven in history, that is real money, at least as a hedge to that situation. And I think that even if you are bullish about equity markets, and even if you have a sort of positive stance on risky assets because of monetary policy, and even if you believe that there's going to be some inflation and pickup and an improvement in growth, even if you do that, it's very important to have, in my opinion, some silver, some gold in your portfolio that gives you that edge, that hedge that the rest of assets don't give you, because of the immense correlation between asset prices. Look at what's happening in November and December. It doesn't matter if you're in emerging markets in Europe, in the US, in commodities. It doesn't matter. Everything is going up in tandem. Things go down in tandem as well, as we remember.
Yeah. Now, another question here in regards to what's happening in Europe, and it says, do you think Europe shall put the Instex in place before the end of the first quarter of 2020?
Very difficult. Very, very difficult. In my opinion, the level of agreement that needs to exist is nowhere to be found right now. Mm-hmm. And in my opinion as well, the challenges that the Eurozone is going to find next year. Remember that something has escaped markets in this last couple of weeks. That is that the European Commission has presented an incredibly aggressive program of a sort of Green New Deal that the Eurozone is going to, the European Union, is going to implement no matter what. Mm-hmm. And there's Poland, there's Hungary, there's numerous countries that are in the opposite side of that policy of going aggressively interventionist, So there are numerous things that might keep the European Union more busy in getting some level of agreement than than financial and central bank, as well as unification of norms. We can talk.
Interesting. Now, I'm curious to get your thoughts on this next decade, and so I want to touch on the China and U.S. trade situation. And so, what are your assessment on that? We're being told that Trump wants a great deal, whatever that deal is. Apparently, there's a phase one, nothing signed. Looks like it's agricultural focus. So, what are your thoughts on that? Is there something more in the bigger sense than what we're being told in regards to a trade deal?
I think that the what we know so far of the phase one trade deal is extremely vague and very difficult to implement. Very difficult to implement. The figures that I've read and heard from some of the U.S. administration about doubling imports from the U.S. to for China is almost impossible to do, considering where they are, where China is right now in terms of growth, in terms of consumption, etc. But if they do, which is a possibility, it's going to be a zero-sum game, because there is absolutely no evidence that China is importing less than what they need. There is actually all the evidence that they're importing a lot more than what they need if you look at the inventory build. So my point is, the phase one trade deal was not too much of a challenge. Why? Because it was basically going back to where we were a few months before. And that is not so much of a problem. And there's a few vague commitments from one. The problem is the second deal, and what you were just mentioning, this big trade deal that actually makes a difference in terms of the trade deficit that the United States has with China. That is very challenging. It's very challenging. I have not seen anything concrete about the what they are going to do about intellectual property, which is a huge problem in the trade deficit of the U.S. with China. I haven't read anything concrete either in what they're going to do about capital controls. Remember that China has the tightest capital controls of the large economies in the world, and I haven't read either anything clear about what is the path in order to address the imbalances in some of those imports and exports that the two economies have. So that is the challenge for me. And what I would say is, look, phase one trade deal, okay, good for sentiment. Second phase, much more challenging. In any case, be it phase one, phase two, or however you want to call it, very challenging that these levels of agreements that we are seeing, with the level of vagueness that we're getting, are going to be big trend changes in the global economy. That is what I think is the most risky part of looking at the trade deals. From sentiment side, I understand.
Interesting. So I'm curious to get your thoughts on the future. And so everything comes to an end. The United States of America has been leading the world in several categories for several decades now, due to the Federal Reserve note being the primary reserve currency. And so I've noticed that over the last couple of months, years, the de-dollarization process picking up. It's now a mainstream concept. And everyone knows that China and Russia have publicly announced that they are dialing back from supporting the debt binge that the U.S. is on. So they've formed all types of organizations. We got the Shanghai Cooperation Organization, AIIB, BRICS, all that, the Belt and Road. Is that the future?
Yeah, well, obviously, a world reserve currency is not just world reserve currency because of its strength, but because of the weaknesses of the other currencies. This is critical. It is a relative game, and a lot of times when we talk about the risks to the U.S. dollar, we tend to oversee, or at least ignore, many of the traits and many of the challenges of the other currencies that could be contenders to the US dollar. What is the big problem of the yuan? The big problem of the yuan is that, despite what some people out there say, it has absolutely no gold backing. It's the total reserves of gold of China, even if you multiply them by 3, are nowhere close to 1% of the money supply of China. China's yuan is as fiat and as challenged as all of the other currencies globally. Same with the euro. And same with the euro. Nobody disputes this with the euro, because everybody understands the internal challenges of the European Union and the Eurozone. So the dollar is getting stronger because of the weakness of the contenders. And the weakness of the contenders is exacerbated precisely by the biggest mistake, in my opinion, the Achilles heel of the contenders to the dollar in terms of fiat currencies. We can discuss gold and other cryptocurrencies, etc. But the rest of the contenders have fallen into the trap of believing in the inflationary mirage. So the mistake that China made was to try to use all of that massive money creation from the PBOC to buy commodities that are worth less today than they were at the time, and to buy reserves of raw materials that today are worth a lot less than they were at the time. Therefore, at the end of the day, what you have done is to devalue your currency by buying things that are less of a reserve for you. The other problem is that you cannot be a contender to a fiat currency by making the same mistakes as the Fed without doing what the Fed does. The Fed always has an eye on the secondary market. Is always looking at what is happening in the secondary demand. If you do all the mistakes of the Fed, but without the capital freedom and without the improvements in transparency and the insight into the secondary market that the Fed has, then you're never going to contend with the US dollar. So the point is not going to happen in the short term. Might very well happen in the long term, but it might not even be from a fiat currency from another big country. It might be because of a change of monetary system into something that's more tangible.
Interesting. Now, what are your thoughts on central banks, especially in the European Union area? I know France mentioned that by 2020 they're going to have a CBDC, central bank digital currency, and so I'd assume that plays into removing paper notes out of circulation and just issuing solely digitals. So, do you see that being a part of the future, and what would that look like in your opinion?
Yeah, absolutely it is. Unfortunately, because obviously a central bank cryptocurrency is an oxymoron. It makes no sense. The reason why any investor wants cryptocurrencies is because there is no central bank involved anywhere in the process. But I do see what they're looking at, which is the destruction of physical money and the creation of just digital money, because that makes it a lot easier for the central bank to generate the imbalances that central banks' monetary policies tend to look at.
Interesting. Now, as we draw towards the end, I'm going to open up the phone lines because I see in the chat here a couple people said they attempted to call in, so I want to be respectful of your time. So if anybody have any thoughts or questions last minute, give us a call. We'll definitely get that answered. And then here's a very unique question here from Mr. Wade. So he's throwing out a lot of good questions. He says, Daniel, do you think Russia will or would cut the EU off from Rosneft if they follow the U.S. sanctions?
No. And the reason why they don't do that is because the EU is dependent on Russian gas, but Russia is dependent on EU inflow of capital. If Russia does not sell that gas to the EU, who are they going to sell it to? That is the question, and sell it competitively. That's important, no? So the point that I'm trying to make is Russia has very successfully navigated sanctions, and has done a very good job in at least maintaining relationships with the European Union at a moderate level, and the European Union as well. So I think that we're likely to continue to be on the same path, but I wouldn't say it's a possibility to see that level. There's interdependence there. It's not just customer dependence.
Interesting. So I'm curious to get your thoughts. Just I'm gonna throw out this recession in 2020, or will the repo activity, all this additional activity, prolong expansion longer? And then you've covered all the problems. What are some strategies, ideas, solutions, things that you personally have done yourself, would do yourself, or just give to your mainstream investor? Yeah,
I think that you need to continue to be exposed to risky assets, because central banks are going to continue to work on that, and it's going to, and you still have an environment that is positive for risky assets. What I think that you need to do is to be less exposed to the most cyclical part of equities. Definitely, you need to be less exposed to multiple expansion ideas, and there's actually plenty of things that you can own and be comfortable with, despite the fact that sorry, my battery is going.
No problem. So we will get ready to wrap this down if I didn't lose them already. So I might have lost them. We'll see if I can get them back on here. And so I'll wait to see if we can get them back on. But with that being the case, that will conclude today's live stream, it looks like. And so it's been great having Daniel Lacalle join us for a live stream. So I want to definitely point back to where you guys can find out more of his work from. And so if you go to Daniel Lacalle or dlacalle.com, here's some of his books here. I definitely want to acknowledge him for that and thank him for joining us here on Rethinking the Dollar. So with that being the case, we might just dial back officially because, once again, the interview looks like it has been brought to an end. And so with that being the case, everybody, it's been great hanging out with you guys. I'm definitely curious to find out your thoughts. Leave your thoughts and comments beneath this video here, and I will touch on them later on. I'll try to get to a late night live stream. But as always, time and everything else in between makes it challenging. But hope you guys had a chance to enjoy this interview this afternoon. And as always, if you guys have enjoyed this, continue to share this information, put this out there, because once again, we have a PhD economist / hedge fund manager, author, college professor. So he covers a variety of sections, and he's not mainstream based. And so he's giving it straight from the heart in a true fashion. So I think that's what's needed these days. But that being the case, I'm about to dial back and go from there. But other than that, it's been great hanging out with you guys this afternoon. If you want to support the channel, give it a thumbs up right now. Share this video, and then up here, become a Patreon, and that'll be a blessing to the channel. Allow me to do more of this because it'll allocate more time for me to do so. But that being the case, be blessed, be safe. I'll see you guys later. Peace. Hey there, sorry for this interruption, but I wanted to bring something to your attention. If you've been enjoying this live stream, why don't you partner with me and be a support to the channel via Patreon membership for just a minimum of $5 a month. All you have to do is scroll down beneath this video here, click the Patreon link, then consider donating as little as $5 a month towards the channel. A little bit of crumbs can go a long way, and I appreciate your support. Now, let's get back to this live stream.